Welcome to the fifth homework set. Again, part one has three subsections, A, B, and C. Remember, the main theme here is dealing with applying cost flow assumptions to a set of inventory, facts, as you'll see it here. In other words, the information I'm giving you here is mix of purchase and sales of inventory for a penultimate corporation. So I mixed everything together, but I gave you a chronology so that it's possible to do a perpetual analysis where applicable. So that's the other main idea here as well. All right, so we have beginning inventory, and then there was a couple purchases, and then two sales, a third purchase, a third sale, fourth purchase, fourth sale. Now, again, for part A, all we want to focus on here is what? Purchases and beginning inventory. We don't care about any sales with regard to this. So all we care is about wherever it says inventory or purchase. Because the thing I'm asking you here is, first of all, how many units did they have available for sale? In other words, what's the maximum number of units they could have sold during the period? Again, this is going to be for the month of October that we're analyzing this. So in other words, add up all these units here. You'll get 1,500. Throw this in here. You'll get 2,350 plus another 300 units that were acquired here. Gives you a total of 2,650 units available. Now, if you want the cost of the merchandise that's available for sale, or goods, those are interchangeable, add up all of these costs here. I basically just gave you this. This just becomes an exercise in just sitting down with a calculator and adding those five numbers together. So if you total all that, you'll get cost of goods sold, merchandise, or pardon me, goods available for sale or merchandise available for sale, same thing. You'll get 176,550. Again, what is the practical reason for understanding that number? That's your upper limit for cost of goods sold. It can't be any higher than that. If you sold all 2,650 units, that would equal your cost of goods sold then, so you'd be done. But of course, what happened? You didn't sell everything. Right? So if we look at the last pieces, how many units did they sell? Right, so now we can just focus rightfully on wherever we see a sale. Now notice I didn't give you any information about what they sold the units for, because we're doing cost analyses. What we sold them for is not important. So in this case, we're going to focus on the total number of units sold there. First and second sale was 1,100, and the third and fourth sale was another 1,100, so the total number sold is 2,200. Now, why is that important? Well, if we sold 2,200 units, take the 2,650 minus that, that means that we have 450 units in our ending inventory. So we need that number in order to do the analysis that we're about to in a moment. All right, we'll proceed to part B here. Again, we're going to analyze under three cost flow assumptions: FIFO, LIFO, and average cost, assuming that we have periodic inventory. In other words, we're just doing this for the whole period, and we're going to determine both what ending inventory is and what the cost of goods sold are under each of these three assumptions. So first up, we'll focus on first in, first out. And remember, what's easier to analyze, what we sold or what's still around at the end of the period? So remember, what's happening is cost is occurring under first in, first out in this direction. We're selling from our oldest units to our newest, but our inventory is happening from this direction, right? So this is the direction that we're most interested in, is that inventory direction. So where's inventory coming from? Newest to oldest. So we have 450 units that we have to account for, and those are the 450 we assume are still sitting in our inventory at the end of the period. So that's going to encompass all 362, so that's 18,600, and then what? Another 150 units at 650. Trust me, that is a 1 and a 5. Now look at the next page, and hey, it's all clear there. So in other words, all 300 of the last purchase plus 150 from the third purchase. Multiply that out, add it together. So we're going to say that the value of ending inventory is 28,350. If that's true, we're going to subtract that 28,350 from what? The cost of what's available for sale, the 176,550. So that means that we'll say our cost of goods sold is $148,200 as a consequence of that. All right, so that was first in, first out. Now we're going to switch to last in, first out. Everything is topsy-turvy now. Now our inventory is going to come from what? It's going to come from our oldest units, because we're assuming we're selling our newest stuff. So in other words, cost is happening from this direction. newest to oldest inventory from this direction, oldest to newest. Now notice, we only need 450 units, and our beginning inventory consists of 500 units at 70, so all 450 units are going to be at $70. So that's what you'll observe here. So 450 at 70. So our inventory, ending inventory, is going to be costed at $31.5. We'll subtract that from the cost of what's available for sale to get our cost of goods sold at $145.50. All right, so again, what we're observing here is a little bit different than what we did in the example that I gave you in my handouts in the other video, what we analyzed there. So here what you're seeing is what? We have a higher cost of goods sold under first in, first out, and it's smaller under last in, first out. That's different than what we saw before, because why? Well, look what's happening to your cost here. Your costs are going down, right? They started at $70 and went down to $62. So as a result, everything switches on its ear. In other words, you're going to see like which one of those is going to be beneficial for your net income versus what's going to be beneficial for your taxes are going to be flip-flopped. So now we'll see that last in, first out is going to be what? Better for net income because it's going to give us a smaller cost of goods sold as compared to this one. Whereas first in, first out will give us, because of this higher cost of goods sold, that means our gross profit's smaller, and then our net income is ultimately smaller, so that's why it's better for taxes. Again, because we have what? A period of declining prices. That's why all that's true. All right, so the last one we're going to investigate is average cost. So for this one, again, all we want to do is do a weighted average. So we just take what? We take our 176,550 divided by 2650 right there, and we're going to get an average inventory cost rounded to the nearest penny of $66.62 per unit. Multiply that by the 450 sitting in ending inventory and round to the nearest dollar. Again, how you punch this in your calculator, you may be plus or minus $1 different from what I'm showing you here. So 29,979 or 980 is the other variance you'll see here. It's going to be our ending inventory, same as before. We are going to subtract that from the cost of what's available for sale to get cost of goods sold under this assumption of $146,571. As you would observe, these numbers for average are somewhere between the FIFO and the LIFO numbers for all, or whatever we're discussing. Cost of goods sold or ending inventory value. It's going to be somewhere in the middle. All right, so everything that we were doing here was assuming a periodic system. Now, what if we switch to a perpetual inventory system and ask for the same thing? Well, under first in, first out, guess what? We get the same analysis because, remember, FIFO periodic and perpetual always give the same answer. So I didn't bother to step through the analysis. I could have if I wanted to, but I just decided to say, well, don't worry about it. It's the same. And in a practical standpoint, from, in other words, if you're answering a test question or a homework question, just do what? Do the periodic analysis we did here, and you get the right answer 100% of the time. But if you do the perpetual analysis, you will, if the proof meets out, it will give you the same numbers. In other words, we'll get 28,350 for ending inventory, 148.2 for cost of goods sold. Now remember, that will not be true for last in, first out. Now remember, I showed you this crazy 9-column format in the handout for this chapter, this homework. So there's an actual way you can tackle doing a LIFO analysis in a 2-column format, and then you convert it to basically 3 at the end when you need the total cost. So that's what you're looking at here. Now, it looks kind of crazy. I don't think you find this in any textbook, by the way, whether you are working with one or not. It's just not there. It's just something I came up with. So what you do is you just basically calculate everything in just these basic 2 columns. In other words, a column for quantity, meaning in terms of units, and then unit cost. That's all you care about. Now remember, the first 3 things that happened in this example, let me pause it for a second. The first 3 things that happened were all just beginning inventory and purchases. So that's all you're seeing here. In other words, we started out with we have beginning inventory 500 at 70, 700 units at 68 were acquired, another 300 at 67. Like, acquisitions are not a complicating factor. Sales are a complicating factor. So the next thing that happened chronologically was there was that first sale of 600 units. Now that's where you have to apply the cost flow assumption. In other words, where did those 600 units sold come from? So here, that's what I'm just indicating here, is we sold 600 units. Where did they come from? Now remember, when you're analyzing this inventory here, these three layers, and you're using last in, first out, you assume that you're selling whatever your newest stuff is. The newest is always going to be what? Whatever's on the bottom going upward, right? You're selling from newest to oldest. So whatever's on the bottom is where you're going to start your analysis. So we sold 600 total units. Where did they come from? Well, the 367, we'll assume all of those were sold. Because again, that only accounts for half of the total amount that was ordered. And then the next 300 units came from the $68 layer. Now here's the part that becomes maybe a little confusing, but it shouldn't be. Just bear with me here. Maintain the chronology of your acquisition. So that's what I'm showing you when I get to this thing called net units. In other words, I'm just transferring this information here. I'm just saying, okay, based on what we just saw right there, what we just sold, that means we still have all 500 units at $70 available. And remember, we sold 300 of these units here, so that means we have 700 minus 300 equals 400 units at 68. So by doing this, maintaining the chronology, when we have another sale, we can properly analyze our cost flow assumption. So we have to maintain that integrity. All right, so next thing that happened chronologically was another sale. Going back to the original, so we have another sale, in this case, a sale of 500 additional units, right? So 500 units. Where did those come from? Same idea. In other words, these 500 units had to come from your newest stuff. So that means all 400 of the $68 units are assumed sold. Since you didn't have anything else to choose from, you're going to pick 100 of the $70 units are now sold. So that leaves you what? Because it's 500 minus 100 units equals 400 units at 70. That's the remainder from there. Now the next thing that happens chronologically is you'll have an additional purchase of 850 units at 65. So that's what you're observing here. I just took that acquisition, third purchase, 850 at 65, and just laid it in under the 400 at 70. Again, purchases are the easy thing you're dealing with here. They're not complicated at all. It's when you get to the sale that's where you have all the quote-unquote problems. Now the next thing that happens chronologically is there's a sale of another 700 units. The third sale, 700. So now what is your newest stuff? So at that point in time, those 700 units, we're going to assume all of them came from the $65 layer, which means we still have all 400 units at 70, and we have 850 minus 700 equals 150 units. But then, of course, what happened chronologically next, to go back to the source material here, is we had a fourth purchase of 300 units at 62. So we just slide those underneath. So we have 400 at 70, 150 units at 65, and an additional 300 at 62. So the last thing that's going to happen in this analysis, which we're almost done with, that fourth sale is going to be 400 additional units. So where did they come from? Well, what's your newest stuff? Whatever's on the bottom. So the 300 at 62, we assume that's gone. And then we only need another 100 units, so 100 units from the $65 layer. So that means you still have all 400 of those $70 units still hanging out. And remember, you have the what? 150 minus 100 equals 50 of those remaining, so 400 at 70. And then the 50 at 65. So again, there's your 450 units we were talking about earlier. Now multiply it out. So 400 at 70 is 28,000. 50 at 65 is 3,250. So we get 31,250 for our inventory. Subtract that from the cost of what's available, and we'll get 145.3 as our cost of goods sold. Now compare that to the periodic example. Now they're pretty close, right? They're not wildly different. Not wildly different. So here we have 31,500 instead of 31,250, and we have 145.50 instead of, over here we have 145.3. So there's a $250 discrepancy between those two numbers. That's all there is. It's not that big of a deal. Again, where did that discrepancy arise from? Well, just look at here. Again, in the original example, we had all 450 units at 70. Therefore, we had an additional $250 of being inventoried under that assumption. Whereas here, those extra 50 units are what? Only at 65. So in other words, the difference is 70 minus 65 gives us $5 times 50 units equals our $250 difference. So that's where that $250 came from. But the point you should get out of this ultimately is, remember, there are differences between FIFO, between LIFO periodic and LIFO perpetual. So in any assignment and any problem in a test, whatever they tell you the assumption is for how they're handling inventory, periodic, perpetual, incorporate it in your answer, because you will get different answers depending on the analysis. Again, if you analyze this material doing a periodic assumption, you'll get one set of answers. If you do the same thing perpetually, you'll get another set. So that's why you got to do exactly what they tell you to. Periodic analysis or perpetual analysis for last in, first out. And yes, you can trust that there will be no questions on a test that will be anywhere near this complicated. Now, I did not include any average cost perpetual, because again, I showed you an example of how that works in the videos and in my handouts, and that's good enough. I'm not going to test expressing on it in this class, so you don't have to worry about it in that context. But feel free, if you want to step through this example, because the numbers are there. I've had students do it just for the heck of it. If you want to step through it and then go ahead and figure out what the perpetual numbers would look like for perpetual average cost, go ahead. Just to give you what's the key of what you'll have to do here. Remember, you'll have to take all of your costs, right, just to give you just like a quick refresher here. In other words, add up all of these costs right here. And just so you have that at your disposal, so if you add up all these costs, you'll get 1027 divided by these total units, 1,500. You don't get real round numbers here. It's another reason why I really didn't want to have you do it. So you get $68.47 a unit. But the thing to keep in mind is that's how much you'll say the cost of the units, the 600 and the 500 are. You'll use that same $68.47 for both of those. And again, I would recommend rounding to the nearest dollar. So again, you'll have a total of what? 400 units left at $68.47. Whatever that cost is, you'll add the $55,250 to that. And then you'll divide that by what? 1,250 units. And again, whatever that unit cost is, you'll use that for the third sale, so you'll multiply that times there. Now, of course, what will that leave you? That will leave you, so you'll be 1,250 minus 700, so you'll have 550 units. Or I'm totally screwing that up, probably. I'm a little tired when I'm doing this right now. I will stop there so that this video remains intact. How about that? So again, go for follow the steps that I gave you when I was more cogent than I am at this moment. How about that? That probably is going to work a lot better. I think I was actually not too far off the path there, but I'm just not going to go any further there. All right, so again, you don't have to worry about the perpetual average, but again, if you feel like doing it, step through it. The numbers are there. Anyways, that concludes part 1 of the homework 5 set. So look for parts 2, 3, and 4. I'll probably do those in one video because they're all kind of short subject matters. So I'll see you there.